Hello, friends, and welcome back to the Frank American. The next time someone places a clipboard in front of you at a bank, a hospital, an insurance agency, or even a lawyer's office and asks for your signature, stop for a moment before putting pen to paper. Watch this video first. Many of the documents tucked inside those thick stacks of paperwork look harmless and routine. They appear to be standard forms that everyone signs without a second thought. But hidden among them are documents that older Americans sign every day without realizing consequences. Some can quietly strip away important legal protections. Others can give companies permission to charge fees or costs that might otherwise be challenged. And one particular document has the potential to put a person's home and financial security at serious risk. In today's video, we are going to examine 6 specific documents that deserve much closer attention. We will discuss what these forms actually mean in plain language, why organizations often rely on people signing them without reading every detail, and what steps you should take before agreeing to anything. Understanding these documents could help protect your rights, your finances, and your future. Make sure you stay with me all the way to the end, because the final document on this list is by far the most important. It is the one that can have the biggest impact on your life. And in just a few moments, I will explain exactly why it deserves your full attention. But before we continue, take a moment to subscribe to the Frank American and turn on notifications. The financial mistakes and legal pitfalls we discuss here are often the very things banks, hospitals, insurance companies, and other institutions never take the time to explain. The people who follow this channel learn about these issues before they become expensive problems. Subscribe now, and let's get started. But first, I want to give you a preview of the final document on today's list. It involves a form that millions of parents sign with the best intentions, usually because they want to help their children. What many do not realize is that this single piece of paperwork can expose their home to risks connected to a child's divorce, financial troubles, creditors, or even lawsuits that have absolutely nothing to do with the parents themselves. Stay with me, because we will cover that in detail later. Let's begin with the first document. The overdraft protection enrollment form at your bank. When you open a checking account, there's a very good chance the bank representative will encourage you to enroll in overdraft protection. They often present it as a convenient safeguard, a way to prevent embarrassment if you accidentally spend more money than you have available in your account. What rarely gets explained clearly is the true cost of that convenience. Federal banking rules, including Regulation E, require banks to obtain your explicit permission before they can charge overdraft fees on most debit card purchases. They cannot automatically sign you up. They must first get your consent, and the document they present for that purpose is the overdraft opt-in form. What are you actually agreeing to when you sign? Imagine your account balance is $3, and you use your debit card to buy a $4 cup of coffee. If you have opted into overdraft coverage, the bank may approve the transaction anyway, and then charge an overdraft fee afterward. At many major U.S. banks in 2026, that fee averages around $35. In other words, a $4 purchase can quickly become a $39 expense. And if several small purchases go through while your account is overdrawn, multiple fees can pile up in a single day. What most customers are never told is that there is another option. You can simply decline overdraft coverage. If you do not enroll, a transaction that exceeds your available balance is usually declined at the register. While that could be inconvenient, a declined purchase costs nothing. An overdraft fee, on the other hand, comes directly out of your limited funds. For seniors living on fixed incomes and carefully managing monthly expenses, avoiding unnecessary fees can make a significant difference. In many situations, declining overdraft protection is the more financially sensible choice. If you previously signed an overdraft authorization form, you are not locked into that decision forever. You can contact your bank and request that the coverage be removed. Once the change is processed, future transactions that exceed your balance will generally be declined instead of triggering overdraft charges. Now, let's move to document number 2, the binding arbitration clause hidden inside your bank account agreement. When a new account is opened, customers receive a lengthy deposit account agreement. Most people never read the dozens of pages contained in that packet. They simply sign where instructed and move on. Buried somewhere in that agreement is often a mandatory arbitration provision. By accepting that provision, you may be giving up your right to bring a dispute before a judge or jury. Instead, disagreements with a bank must be resolved through private arbitration. That includes situations involving billing mistakes, unauthorized transactions, account disputes, or allegations of improper conduct. Why is this important? Historically, class action lawsuits have been one of the primary ways consumers have held large financial institutions accountable for widespread misconduct. Private arbitration, however, typically limits that type of collective action and keeps disputes out of public courtrooms. Many people are unaware that some banks periodically provide customers with an opportunity to reject arbitration clauses. In certain cases, customers can preserve their court rights by sending a written opt-out request within a specified time frame after receiving notice of the policy. When banks revise account agreements, they generally notify customers of those changes. Included in those notices may be instructions explaining how to opt out. A smart step is to review any recent account agreement updates you have received from your bank. Search your bank's name together with the phrase arbitration opt-out and determine whether an opt-out process currently exists. If it does, send your request in writing and keep proof that it was delivered. A small amount of effort today could preserve important legal protections in the future. Next is document number 3, the surprise billing waiver sometimes presented by hospitals. Federal protections established through the No Surprises Act were designed to protect patients from unexpected bills generated by out-of-network providers working inside in-network facilities. This protection has helped many patients avoid large and unexpected medical expenses. However, there is a form that can significantly reduce those protections. Hospitals may present what is commonly called a notice and consent form, or surprise billing waiver, before a scheduled medical procedure. By signing it, a patient may voluntarily give up certain protections that would otherwise apply under federal law. Many people sign this paperwork as part of a larger stack of intake forms without fully understanding what they are agreeing to. If an out-of-network provider later participates in the procedure, the resulting charges may become the patient's responsibility rather than being limited by federal protections. The form itself is legal. Hospitals are allowed to offer it. What patients should remember is that signing it is not always required. For emergency treatment, federal protections generally remain in place regardless. For non-emergency procedures, patients should carefully review any waiver before signing and ask questions if anything is unclear. If someone tells you that the form is mandatory, request clarification from a patient advocate, financial counselor, or billing supervisor. Never assume a document is routine simply because it is included in an intake packet. Now, let's discuss document number 4, hospital arbitration agreements. This is different from the billing waiver we just discussed. Some hospitals and medical facilities include arbitration provisions in their intake paperwork. These agreements can require future disputes, including certain malpractice-related claims, to be handled through private arbitration instead of the traditional court system. Without such an agreement, a patient who believes they were harmed by negligent care would generally have access to the court process and potentially a jury trial. The arbitration document changes that process. There is an important distinction regarding emergency treatment. Under federal law, hospitals with emergency departments must provide emergency medical care regardless of a patient's financial situation or whether specific paperwork has been signed. Emergency care cannot be denied simply because a patient refuses an arbitration agreement. For non-emergency procedures, however, providers may have different policies regarding arbitration requirements. Before signing, ask whether the arbitration clause can be removed or declined. In many situations, especially within larger healthcare systems, patients may have options they are never informed about unless they ask. Also remember that some states provide limited periods during which certain arbitration agreements can be revoked after signing. If you have concerns, review the laws in your state and determine whether cancellation rights are available. Now let's move to document number 5, insurance auto-renewal authorizations. Insurance companies are generally required to notify policyholders when premiums are changing. The problem is that these notices often arrive in lengthy documents that many people never read closely. Customers who have remained with the same insurer for years frequently assume their rates have not changed much and allow their policies to renew automatically. That assumption can be expensive. Insurance companies increasingly rely on sophisticated pricing models that recognize customer behavior. Long-term customers are often less likely to compare rates with competitors, and some insurers take advantage of that tendency by increasing renewal premiums over time. Many seniors have discovered that their premiums continue climbing despite maintaining clean driving histories and making few or no claims. Meanwhile, consumers who compare policies and switch carriers when appropriate often find substantial savings. The easiest defense is to stop relying solely on automatic renewals. Instead, mark your calendar approximately 45 days before each renewal date. Review your coverage, compare quotes from competing insurers, and make an informed decision rather than allowing the policy to renew without examination. That simple habit can help prevent years of unnecessary premium increases, while ensuring you continue receiving the coverage you actually need. Take advantage of that period before renewal to gather quotes from at least 3 competing insurance companies. Once you have those numbers, compare them directly with your current renewal offer. If another insurer is offering similar coverage at a lower price, contact your current agent and ask whether they can match or beat the competing rate. In many cases, they have flexibility that is never mentioned unless the customer asks. If they are unwilling or unable to lower the premium, do not be afraid to move your coverage elsewhere. Spending 20 minutes comparing rates can produce savings that last for an entire year. For retirees and seniors living on a fixed budget, few financial habits provide a better return for the time invested. Now, we come to document number 6, the one I mentioned at the beginning of this video. This document involves adding an adult child to the deed of your home as a joint tenant. Of all the documents we have discussed today, this is the one where good intentions most often lead to serious and unexpected consequences. Many parents want to simplify the transfer of their home after they pass away. They hope to spare their children the delays and expenses associated with probate. Because of that goal, they are frequently advised by friends, neighbors, relatives, and sometimes even professionals outside the estate planning field to simply place their child's name on the property deed. It sounds simple. It sounds helpful, but it can create risks that many homeowners never see coming. The moment a child is added to the deed as a joint tenant, that child becomes a legal owner of the property immediately. Not sometime in the future, but right now. And once they become an owner, their share of the property becomes connected to everything happening in their financial life. Suppose your child is involved in a lawsuit arising from a car accident. If a judgment is entered against them, a creditor may attempt to place a lien against their ownership interest in the property. Suppose your child goes through a divorce. Depending on the circumstances and state law, their ownership interest in the home could become part of the issues examined during the divorce process. Suppose your child develops significant tax problems or other debts. Creditors may view their ownership stake in a home as an asset available for collection efforts. The important point is that none of these situations require bad behavior or poor decisions. They can arise from ordinary life events that affect millions of people every year. There is another issue that families often discover only after it's too late. Taxes. When a home passes to children through inheritance, the property generally receives what is known as a stepped-up basis for tax purposes. In simple terms, the property's tax basis is adjusted to its fair market value at the time of the owner's death. Imagine a home purchased decades ago for $80,000 that is worth $400,000 when the parent passes away. Under a stepped-up basis, the child's tax basis becomes $400,000. If the property is sold shortly afterward, capital gains taxes may be dramatically reduced or even eliminated. However, when a child is added to the deed during the parent's lifetime, the tax treatment can be very different. Part of property may continue carrying the original purchase basis, potentially creating a much larger capital gains tax bill when the property is eventually sold. For families whose homes have appreciated substantially over the years, that difference can amount to many thousands of dollars. Fortunately, there are safer alternatives that often accomplish the same goal. One option is a Lady Bird deed, which is available in certain states, including Florida, Texas, Michigan, Vermont, and West Virginia. This type of deed allows a homeowner to maintain complete control over the property during life, while permitting a direct transfer to beneficiaries after death without probate. Another option available in many states is a transfer on death deed. It works in a similar manner by allowing property to pass directly to designated beneficiaries without creating immediate co-ownership. Both approaches are designed to help families avoid probate while reducing many of the risks associated with adding a child as a joint owner during the parent's lifetime. So let's review everything we covered today. Be cautious about enrolling in overdraft protection. A declined transaction may be inconvenient, but it is often far less expensive than paying repeated overdraft fees. Review your bank's account agreement and determine whether there is an opportunity to opt out of mandatory arbitration provisions. Think carefully before signing surprise billing waivers at medical facilities, particularly when they involve protections you would otherwise receive automatically under federal law. Pay close attention to arbitration clauses contained in hospital intake paperwork and understand the rights available to you in emergency situations. Avoid letting insurance policies renew automatically without first comparing competing offers and reviewing your current premium. And if your goal is to pass your home to your children efficiently, explore estate planning tools designed for that purpose rather than automatically adding them as joint owners on the deed. The reality is that most institutions are not going to sit down and explain every possible consequence of the paperwork they place in front of you. They expect forms to be signed quickly and returned without much discussion. That is why taking a few extra minutes to read, ask questions, and understand what you are agreeing can make such a difference. Now you know what to watch for the next time a stack of documents appears in front of you. If you found this information helpful, subscribe to the Frank American, share this video with friends and family, and send it to anyone who may soon be opening a bank account, visiting a hospital, renewing insurance coverage, or making important decisions about their home. Thank you for watching, and I'll see you in the next video.